Welcome to the focusIR Fireside Chats with me, Karl West. I will be bringing you interviews with fund managers, economists and analysts. Plus, we'll be sitting down with the founders, directors, CEOs and company chairs that make things happen in the boardroom. I hope you enjoy the show. I'm joined today by Richard Penny, who is the Senior Fund Director at Oberon Investments and a specialist in the small company sector. He runs the TM Oberon UK-Small Caps Fund. Richard joined Oberon as a fund manager in November 2024, bringing experience from Crux Asset Management, which is owned by Lansdowne Partners, where he managed the UK Special Situations Fund from October 2018. He previously worked at Legal and General Investment Management for 15 years and has held roles at M&G Investment Management and Scottish Amicable Investment Management. Richard, welcome.
Thank you. Thank you for inviting me. Glad to be here.
Yeah, thanks for joining us. So as we were talking off air, I was, first of all, intrigued by your recent post on LinkedIn, where you said, you kind of asked the question, really, are UK smaller companies worth a second look? And your answer was equally fascinating. Not all of them, but the 3.5-year sell-off leaves some UK companies ridiculously underpriced. And we think that there's a great chance to buy long-term growth businesses at distressed prices. As I said, you manage the UK Smaller Companies Fund, and I should just add that fund was ranked first over 1, 2, and 3 years by Citywire. So you clearly know what you're talking about. So why is it, do you think, that small caps and AIM-listed stocks are so undervalued?
So some of it is to do with conditions that started in September 21 when interest rates went up. Classically, that is a period when small companies might struggle. Smaller companies are exposed to the domestic economy. When we look at large companies in the FTSE 100 in the UK, we've got a lot of oil companies, we've got a lot of Unilevers and Diageo's, defensive profiles. Smaller companies are more cyclical, so you get a downturn. So some of it was that. But the downturn we've had, particularly on the AIM market and for microcaps, the bottom 2% companies under 200 million, that downturn has been the worst I've seen in 35 years. And statistically, it's the worst. The AIM market in particular has been 80% worse than the FTSE 100 since September 2021. So some of it was interest rates, and there has been some downturn in profits, but the underperformance has been massively out of kilter because there was very difficult situations as well in 08, 09, 2020. It was obviously difficult, even the dot-com bubble, but the underperformance then was only half of what it is, and this has been 4 years, and it's normally 2 to 2.5. So that's at the top level. When we look at companies and we look at stocks, we have companies that are trading below perhaps the cash they have on the balance sheet, or maybe less than the value of the building that they're in and the working capital that they have. And that's a distressed valuation, and that's something that you really want to be able to take advantage of by buying.
Yeah. You mentioned there that this is the worst downturn you've seen in 35 years or whatever. You've clearly seen enough bear markets in the small cap space in your time. Was this down cycle different to others? And if so, how?
So, yeah, it's been longer. As I say, it's been 4 years, normally 2.5. I mean, so far this all sounds dreadful, but the truth is that when you have these kind of downturns, the recovery is proportionate. And so post-dot-com, the recovery was 135% on AIM. The great financial crisis, nothing great about it, but it, apart from the recovery, was 159%, and in COVID it was 123%. I should probably point out that the funds that I ran, which were trying to buy recovery stocks, we did 173%, so a bit more than the recovery in the GFC. We did 151% coming out of the COVID. So it's been longer and deeper, and that really should mean that sometime in, hopefully fairly soon, but in the next, certainly on 3 years, we should get a proper recovery.
Yeah. We were talking off air about, clearly not all those companies on AIM are bad companies. There's some good companies there that are well managed. You're looking for those gems, and you mentioned that you've you've got some companies in your fund that have, that have done very well. What can you tell us about those companies? What kind of links them together? Just give us a bit more on that.
So we set the fund up 3 years ago to participate in the recovery, which we've only really seen signs of in the last year. So in a strange way, it's slightly extraordinary that we have done well, but it's been stock picking. So we've had 4 or 5 companies that have doubled. We've had one rescue rights, a business called Aptima that went up between 5 and 7 times. Had another business called Zegona, which is Vodafone Spain, again a recovery stock, new management coming in, improving performance. That's been up 10 or 11 times. Those you wouldn't expect to have found in the market phase we've had in the last 3 years. Perhaps, that's really positive for us because it puts us on the right foot. We have had money coming into the small cap fund, and we have been able to double in on companies that we think are cheap at this point right now, and will give us the returns over the next 3 years. So usually there's some element of distress in terms of recovery. It can be a company that needs more money. We've had a 4-year downturn. Companies often run with 2 years cash. So after 4 years, many run out, and you can buy companies maybe that have had 1 or 200 million spent on them. You might be able to buy those for 4 or 5 million. You also have companies where the profits are down. If companies could have made 20 to 50 million, they may well be break even. And because people will put a multiple on a profit number, if you break even, then it's quite, it's 0 times any number you like is 0. But they don't trade at 0, but they can often trade below the breakup value of the factories, and they give you no value at all for market position and the recovery potential, basically. So you have a huge optionality on when you get the recovery. And I suppose there's 3 factors that we think can happen when you get the market recovery. So they're the reverse of what's just happened. So in the downturn, revenue goes down, profits usually fall disproportionately, and then investor engagement goes down as well. And we've seen a massive sort of people moving away from smaller companies and AIM institutionally and to some extent retail. That's improved a bit in the last year. But then those 3 things that worked in a negative way, you get triple whammy, if you like. In the other direction, you get a little bit of a following wind sometimes from the recovery, a bit of economic growth. You get operational gearing, so the profits go up more. And then sometimes the catalysts drive the market caps up to levels where people re-engage with the businesses in bigger institutions.
Yeah. So let's get specific then. Let's name some names. Which have been the companies that have managed to buck the trend in the last 3 or 4 years?
So in the last 3 or 4 years, Zegona was obviously a great winner for us. So we bought them at 150 in a leveraged sort of buyout type structure, where Zegona bought the asset off Vodafone Spain. That's gone from 150, I think they're £17 today. We've had a 160 dividend. Clearly that's a big winner. We have sold quite a lot of that holding, and it remains big in the fund. We've done well with some of the rescue rights. I mentioned Aptima, but there have been other names like that. We put money into a business called Light Science Technology and took that out again. That went up 2 or 3 times. We've had 4 or 5 names like that. And then we're sitting on a load of names where they may well be the price we paid for them or slightly less, but we see really good upside going forward. They could be industrial businesses, they could be refinancings, they could be companies with great products which they've been spending money on but yet to monetize.
Yeah. I mean, you're obviously very pretty confident anyway that we're coming to the end of this cycle, this down cycle. What are the signs that small caps, and AIM particularly, is oversold and things that are about to turn around? What are you seeing?
So I'm most confident about the level of valuation. So when we see companies, we try and work out what they're worth, their asset base, their sales base, their profits, and the profit recovery potential they have. There's such a dislocation in value that at some point the value will out. So we're very much of the school of thought that the market is a weighing machine, not a voting machine. Now, if you want momentum, you go to the US big tech, but they're expensive, and they've been getting more and more expensive for long periods of time. For some people, those are irresistible, but increasingly since April of last year, people are looking at other areas and they are looking at sort of more value alternatives. We're really talking about recovery investing, and believe it or not, contrarianism is out of fashion, but recovery investing, the small cap recovery, as we've said, has given you those triple-digit recoveries multiple times before, and it's often the most difficult to see it at the bottom. If we knew this was the bottom of the market, then it wouldn't be the bottom of the market. We'd already be up 30 or 40%.
You obviously, over the years you've been in the market, you've developed a process. Can you talk us through that? That stock picking process. What is it you're looking for? Are there kind of stages that you go through when you're evaluating a company?
So, I mean, over 35 years now, I've probably done 6,000 or 7,000 company meetings. So we meet a lot of companies. I would say in outline, we're looking for growth, recovery, management who are aligned, competent, and motivated. 3 distinct factors. We tend to find the growth and the recovery at the right price. So price would be a big thing, where companies are small. And right now, the biggest sell-off has been in microcap. So our big winners, when we've had the big recoveries before, have come from buying companies that have dropped down below the radar for most institutions, and buying them when they're totally out of favor, and then waiting for them to recover. So those 5 factors: growth, return on capital, alignment, small or microcap, and price. GRASP, G-R-A-S-P. There you go. There's a little code word for you.
Okay. You mentioned there that they fall out of favor with other investors. I mean, clearly some microcaps, when they get below a certain market cap, funds just stop buying, stop investing, stop tracking. Has that been part of the issue as well with some of these stocks, that they have fallen so low that they've just apart from the likes of you and some others in the market, some of the other investment houses just aren't looking at them?
Yeah, so below £200 million, most of them, the big names that are in the UK small companies, they don't really open positions. So, and that causes debate, I'm sure, and I know, having worked for these large companies, what happens if you buy something at $1 billion and it goes below 200 million and then it goes to 100 million? Well, more often than not, if you're not able to buy it and you're not allowed to buy it, you're a seller. So you have people selling because of liquidity, because of compliance purposes. We all know that everybody says that they buy low and sell high, but there's always a reason and an excuse why they don't do it. We're positioned as a boutique to be the other side of that trade. Yeah, and so many companies have become a lot smaller. And if we look at the AIM market, for instance, I think we've seen, to the end of December, it was a 38% decline on AIM. So we've seen some recoveries in January and December, but 38% average decline. 44% of the stocks are down 80%. And we're talking very much at an index level here, but our aim and our purpose is to find 25 or 30 stocks out of a universe of 500 or 600. So we're not apologists for the whole market. And we've done this before, trying to buy businesses that we can value, that can get conviction on, and where we're confident they're well managed and can recover well.
Yeah. Have you always been interested in small caps and growth companies? What is it about the smaller end of the market that drew you in, rather than opting for more sort of solid blue chip companies?
I started in 1986, Tel Sid, with the privatization issues, moved on to the electricity privatizations. It was kind of free money. And when I was about 18 or 19, I got interested in the small caps, introduced by the Investors Chronicle, I think. And I had stocks like Scion. There's a stock called Electronic Data Processing. They didn't all go well. I had things like Brent Walker, which was very cheap and then had too much debt. A thing called Norton Motorcycles, which was very good until it wasn't. Yeah. Which sounded iconic and wonderful, but wasn't always well managed. So yeah, I was interested in the small companies, and I started off in 1992, which was actually a period when interest rates went up aggressively and then came down sharply, and where I saw actually the first signs of a recovery and the big gains that can be had. Yeah, so ever since, I've been in the UK, investing in the UK, running concentrated portfolios, not too worried about indices, as many institutions are. So that's why we really sort of like doing concentrated stock picking funds in these kind of unit trust retail funds.
Yeah. What's the just jumped into my head because you mentioned there that you have worked for some big operators. What's the main difference for you between working for one of the big houses and now working for a boutique? Is it the flexibility and the kind of autonomy that you have?
Well, exactly. I think you're right there. And to be fair, when I worked at Legal & General, I was allowed to identify a fund and set up a concentrated stock picking fund, which suited the way that I invest money. And so we have the same here. We have a concentrated UK-Small Caps Fund. Because we're a boutique and because the fund is small at this stage, we do have the flexibility to buy in this micro-cap space under 200 million, where because so many companies have come down, it is a huge store of recovery potential that some of the other funds are not able to address.
Okay, Richard, I can't let you go today without asking you about the impact of the recent military action in the Middle East and what what has that done for your outlook for small cap stocks in the UK, and how does a big geopolitical event like that affect your planning and investment decisions? And as a stock picker, how do you respond to something like that?
I mean, there's been big headlines, and I'm been very pleased with how well the fund has held up. Actually, it's done better than it might have done. These kind of volatility periods will come and go, and we've seen it over many years, obviously. But it's been quite pleasing the way things have held up. The effect is secondary in that the effect will be on inflation and the outlook for interest rates. Interest rates will come down less slowly. They might even certainly falls in interest rates in the UK will stall for a little while. But the real opportunity in the UK and the small cap is this kind of the worst sell-off. It's the mispricing and the undervaluation. So it may well be delayed, but I think if people are interested in smaller companies, you have to have a 2 to 3 year view. The longer we move towards that 3 year, the more high conviction we get that this is going to be a triple-digit recovery. We were, and probably still are, actually very confident that it's a good time to buy. Doing the exact timing is always going to be a bit difficult, but when circumstances align that you get so many stocks that are mispriced, you have to at some point pull the trigger and take advantage of it. And the opposite would be the case in the US, where the momentum is great, but there's so much good news factored into prices.
Yeah. Well, Richard Penny of Oberon Investments, thanks very much for joining me today.
Thank you ever so much.
Thanks for listening. Don't forget to hit that like, share and subscribe button on Spotify, YouTube or wherever you get your podcasts.